To attain financial security, the average American needs an annual income of $233,000. However, as of 2021, the typical American worker earned only $75,000 per year. This income gap has heightened concerns about savings, with a recent survey revealing that a significant majority of Americans are living paycheck to paycheck. Notably, this struggle extends beyond low-income and middle-class families, as even high-income households find themselves in the same predicament. According to a BankRate survey, the average American expresses the need to earn at least 3 times their current income to achieve financial security. Alarmingly, over 72% of Americans do not feel financially secure in their current situation, and more than a quarter believe they may never achieve such security. Almost half of Americans are more worried about their savings now compared to a year ago, as reported by a new poll from BankRate. Focusing on consumer financial security, or rather, insecurity. Despite positive trends such as reduced debt and increased savings post-pandemic, concerns persist. Job security and the ability to secure a stable retirement are prevalent worries, affecting nearly 61% of Americans living paycheck to paycheck. This financial strain impedes their ability to cover basic needs, with about 40% struggling to afford housing, food, and healthcare. Even in the midst of a growing economy and a low national unemployment rate, this financial reality persists for millions in the United States. If you find yourself grappling with financial insecurity, you are not alone. The question arises, why are so many Americans trapped in a paycheck-to-paycheck cycle, and what steps can be taken to address this issue? For a full-time worker, the estimated monthly income is $4,400. However, after factoring in taxes and benefits, the take-home pay is reduced to $3,380, which falls short of meeting the cost of living in the United States. The prices of essential services and goods, such as healthcare, education, and housing, have surged in recent years, while wages have failed to keep pace. This surge in prices is notably impacting heating bills and fuel costs. To illustrate, let's examine some of the most common expenses for Americans. The average monthly rent in the United States has soared to $2,029, representing more than 46% of the average American's pre-tax income. Meanwhile, the average mortgage payment for a 2,400 FT house is $1,957 per month. However, a widely accepted rule advises spending 28% or less of one's pre-tax income on mortgage payments. For median gross monthly incomes, this translates to just $1,232. Currently, both rent and mortgage payments rank as the top financial concerns for Americans under 40. Factors like inflation and rising interest rates have fueled uncertainty about whether individuals can afford housing in the coming months. Home prices are setting records, especially in smaller cities, where buyers must act swiftly to secure the houses they desire. In North Texas, for instance, housing prices have surged by an astonishing 130% in the last decade. Traditional high-cost areas like San Francisco, New York, and Southern California are renowned for their expensive housing markets, with New York City surpassing San Francisco as the most expensive city in the U.S. to rent an apartment. Zumper reports that New York City has claimed the top spot on the list for the first time since 2014. Approximately a quarter of the U.S. population believes they would require at least $1 million in assets to attain financial security. This belief has prompted a notable migration to more affordable states like Mississippi, Kansas, or Alabama in recent years. On average, Americans allocate $690.75 per month on food, as per the Bureau of Labor Statistics. When combined with average health expenses of $96.42 per month, the total expenditure amounts to $2,816.17 for renters and $2,744.17 for homeowners. In essence, over 85% of Americans' income, post-taxes, is dedicated to essential expenses. This calculation excludes other vital costs such as transportation, childcare, and debt payments. Essential expenses like food, housing, utilities, car insurance, and homeowners insurance are consistently on the rise, making it challenging to save money. In Florida, property insurance rates are projected to increase by at least 40% this year, according to the Insurance Information Institute. Budget experts recommend that Americans limit their spending to 50% of their net income on needs, allocate 30% for wants, and reserve 20% for savings or debt repayment. However, this recommended allocation faces challenges, as many people end up spending 75% of their available income on necessities, leaving little room for wants and savings toward their financial future. The ability to meet this target allocation varies significantly based on location and income. Another influential factor driving up prices is the impact of interest rates. The Federal Reserve has once again elevated its key interest rate to the highest level in 16 years as part of a strategy to counter inflation. However, some apprehend that the escalating interest rates may be causing more harm than good to the overall economy. Housing purchases are particularly affected, with significant repercussions. For instance, if you purchased a $375,000 house in 2021, your monthly payments would have been around $2,000. Now, for the same house, you would be paying close to $3,400 per month. These increases extend beyond the housing market, influencing sectors like cars and credit cards. Even individuals with impeccable credit scores are facing interest rates as high as 20.5%, reaching up to 30% for those with lower credit scores. Credit cards, which have become indispensable for many Americans, are contributing to historical debt levels. According to the Federal Reserve Bank of New York, credit card debt in the U.S. has surpassed $1 trillion for the first time, with millions of cardholders carrying balances month after month and year after year. Alarmingly, 1 in 3 Americans acknowledges having more credit card debt than savings in their bank account. Experian study has brought to light that the average American carries a substantial burden of $96,300 in credit card, mortgage, and auto loan debt. This predicament arises from the stark reality that the average salary in the United States falls short of covering basic household needs. Consequently, individuals are compelled to resort to accumulating debt as a means of making ends meet. The growing challenge of accessing credit exacerbates this issue, leaving many individuals feeling financially insecure. This insecurity, in turn, hampers their ability to save significant sums of money, resulting in a lifestyle where they are essentially living paycheck to paycheck. According to a recent See Your Money survey, 74% of Americans express stress regarding their personal finances, marking an increase from the 70% reported in April. Moreover, 37% of respondents indicate that they are very stressed about their financial situation. This widespread financial strain underscores that the issue is not isolated, but rather a pervasive concern for many Americans. It is essential to recognize that while debt can be a channel for managing financial resources, its effectiveness hinges on prudent use. American households serve as a cornerstone of the country's economy, necessitating public policies aimed at enhancing the economic prospects of individuals. Given that the economy is closely tied to consumer spending, addressing the financial challenges faced by Americans becomes crucial for sustained economic well-being. The incorporation of Social Security policies holds immense significance as it constitutes the bedrock of financial security for retirees. In numerous cases, it serves as the sole income source, preventing older individuals from slipping into poverty. Monthly Social Security checks are slated for an increase, averaging an additional $140 per month for recipients, the most substantial raise in 4 decades. However, with inflation eroding our purchasing power more than ever, numerous elderly individuals in our community express that this augmentation is insufficient. Employers also bear a crucial role in addressing financial security concerns by ensuring that employees have access to retirement savings opportunities and emergency funds. Additionally, providing avenues for enrolling in essential benefits like health insurance, life insurance, or disability insurance is pivotal. As the number of individuals grappling to make ends meet continues to escalate, this predicament becomes an increasingly pressing issue. The pervasive financial insecurity experienced by many Americans poses a substantial risk to the overall economy. Without proactive measures to enhance the financial well-being of American households, the repercussions are poised to impact us all. It is imperative to address these challenges to foster a more robust and resilient economic landscape.